My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Tavi Costa. Tavi, for those who are not familiar with you, introduce yourself. Who are you? What's your background? What have you done throughout your career? And what are you doing currently?
Well, I am a partner of Crescent Capital. We run 3 different hedge funds, a global macro, long short, and a precious metals, electrification metal kind of fund, where we invest mostly in the metals and mining industry, which is obviously related to our bullish views in natural resources and particularly metals and mining. Most of my background is related to the research on the macro side, as you can see on my Twitter page. I've got a structurally, but I would say bearish view about the economy, particularly equity markets and financial assets, I should say, that are historically expensive. I have views on the treasury markets, but also very bullish in hard assets. I think that we're in the moment of redefining 60-40 portfolios, and it's going to be a very interesting opportunity for investors to be redeploying capital into a place that has been historically underallocated.
So when I initially DM'd Tavi, I always ask the guest I'm going to have on, what do you want to talk about? And the first thing that Tavi said is, well, we should talk about how everybody's fucked. It's a play off of everything that I joke around with on X. And I say that partially in jest when I put it out, but I also do believe that because I think environments like this are very nasty for anybody and everybody, whether you're micro fundamental or macro top down. Now you mentioned, on the macro side, you've got this global macro strategy fund. I'm curious, how have the last, 2-3 years been in terms of, macro trading, macro investing? On the one hand, you can argue that it would have been simple because anybody could have seen, the rate hike coming and the sell-off in bonds coming. I don't know if anybody could have seen the magnitude and speed.
Well, I think it's never simple, number one, but the treasury market we've been writing about it, and you can look back in the last 2 years or so. I think we put out a very bearish note on treasuries, but from a issuance perspective, it wasn't so much on the demand side. A lot of things have surprised us. And I should say the negative impact or just the unfolding of all this, I thought it would have a lot more implications in markets than we've seen so far. It's almost like, you're reading the future of how do we see this loss or destruction of collateral value in fixed income that does not translate into further pain in other things. I think the time to be bearish treasuries was 1 or 2 years ago. The easy money on that, I think, has been made. That's just my opinion. But then you look at NASDAQ relative to treasuries, they're certainly out of whack. And certainly, how do we discount a business cash flow back to its present value with a significantly higher interest rate environment? And it doesn't impact the overall market. It's just hard to believe when you see Russell 2000 turning negative, S&P equal weighted turning negative. And then, Michael, in my view, which is an even bigger elephant in the room, is the credit spreads. You look at credit spreads specifically, and they're still at 2%. If you look at relative to investment grade bonds. And to me, it's like, okay, something is going to break. I just don't see how something doesn't break with rates where they are. But I don't want to be short though, the treasury side. I'm looking for what is likely to break. So what is the source of cheap volatility that is out there? So that's on the macro side. That's what I'm, very focused. I think we're back to the old days on, those potential for deep bags in currencies, back to the 80s and 90s where we've had monetary systems failing and so forth. Well, the main reason for that was because central banks were in deep trouble. And who knows if who is selling those treasuries are a central bank in trouble. I think it's very likely. And so debagging currencies and being exposed to that, to me, is a cheap way to be long vol. Number 2, credit spreads. I think you can be long treasuries and short corporate bonds here. And I think that's an attractive trade as well. I think I've never seen something, but you tell me, have you ever seen something break in the market or in the economy that doesn't cause credit spreads to blow out? I've never seen that in my lifetime. And so,
sorry, but you're hitting on what have been my thesis for the whole year. I said start of the year, melt up dynamic pre-election year, but that there's going to be credit event towards the end because of the lag effects of the fastest rate hike cycle in history. It's also why I myself have been very loud and consistent in saying we were never in a new bull market. Yeah, most bear markets end with a fixed spike. what is a VIX spike? It's a credit spread blowout. There's a direct correlation between default risk
Yeah.
premiums rising, junk debt collapsing, a vol spike in equities, and that typically is the capitulation where everybody throws in the towel in equities, and suddenly that's when the new bull market actually starts.
Yeah. And you have an unsustainable combination of macro forces playing out too, which is interest rates rising, along with the dollar rising, along with financial conditions. They're all kind of self-reinforcing. And, when you look back in 2021, those three lines were also rising. And then they peaked in September with CPI peaking as well. I might have a different view with you on this. I actually think that and I think you agree, we're facing a debt crisis. But in my opinion, it's gotten highly entrenched inflationary problems. And it's the reason why I just completely disagree with the euro dollar curve. I actually think we're probably going to face a stagflationary more type of recession personally. And the reason for that is because the underlying problems causing commodity prices to rise and other things have not been fixed. And, on the oil side, and it's very interesting if I know you've done a lot of work on lumber and gold and other things, but note how markets tend to, in commodity cycles, they unfold through a rotation dynamic. And so you have, right now, what is at the peak level? Well, you got orange juice and you got uranium and you got, still gasoline prices are still rising. Ammonia prices are rising again. Nat gas is starting to rise. Corn is starting to rise. And then you have the other side of it where you got crude prices had a setback recently. You got soybeans had a setback recently. Palladium, lithium was the hot commodity not too long ago. And now it's not as hot anymore in terms of prices. Tin, was hot not too long ago. But they're going to likely come back. And what is likely to come back very soon? Lumber prices look interesting. And then you have, silver prices look interesting. And you got gold prices look interesting. Platinum looks interesting. Copper is starting to move. And it's a different dynamic than the normal cycle. The normal cycle, you'd be short a bunch of the cyclical stuff. And maybe this cycle will play out the same. I beg to be different on that one, just because I do think what's happening, structurally speaking, is highly inflationary. And I think the title of this is The Three Waves of Inflation. Might as well touch on that. And those pillars are just so, again, embedded in the economy overall. You've got, deglobalization forces. Most geopolitical issues are causing companies to go above and beyond to reduce their reliability in those logistics that they used to have agreements with. And that has been translating into higher prices. Number two has been something that a lot of people are dismissing and seeing this as sort of isolated events. And I completely disagree, which is protests. And the protests that we're seeing are related to elevated cost of living and also related to inequality issues, which we haven't seen inequality issues to this degree all the way back to the 30s and 40s. And that creates populism that also increases the deglobalization problem. So that is highly inflationary to me. And, the protest, and then people say, well, but how will, in a weak economy, how do you get wages and, still be pressure higher? Now, everyone should be taking a look at the labor cost relative to profits chart. Going back to, the 40s and 30s, look back on that chart and what you're going to see is that the amount of profits that's being shared with the labor market today is minimum. And so we can see labor becoming a larger percentage of what corporations earn. And that is highly likely to happen, in fact. And in my opinion, it's what's going to squeeze the margins of companies from historically high levels. Despite the fact that we've seen margins decline, they're still really high throughout, relative to other periods in history. So there's room there to be squeezed and increase this, this wage pressure, given the fact that we're seeing, elevated cost of living. So to me, those are important sides. The chronic underinvestments in natural resources, boy, has anything changed in that front? How do we go from reshoring, green revolution, improve affordability of housing without making the metals and mining industry drastically higher in terms of its relevance than what it is currently. I just don't understand how we go there. And maybe we're just not going to go there. Not my view, but maybe that's what's going to happen. Or military spending, that also creates demand for materials. So that chronic underinvestment, natural resources to me, also highly inflationary. And lastly, it would be the fiscal stimulus. I mean, a Wall Street Journal had an article not too long ago basically saying that the fiscal stimulus is not stimulated because majority of it is actually interest payments and other things. And that's just rubbish. That's rubbish research. It's not true at all. Interest payments about 10 to 15% of the overall stimulus that we're seeing. If you look back and you take out how much we're receiving in tax revenues, which has been rolling over, everybody knows that you're seeing, the government spending more and receiving less. So huge divergence between those two charts. But what's more important on that is that take out the interest payment side of it. We're spending 25% of GDP on fiscal stimulus right now. So to me, that's, again, incredibly inflationary, much higher than what we saw in the 70s, with a much worse debt problem. And the economy is just, addicted to this level of fiscal stimulus types of policies. And so, what we have here is that a Federal Reserve is facing an issue where we're seeing falling demand for the federal debt, for treasuries overall, because of all those issues as well. And because of the issuances that we're seeing. And so how would you not see more of an inflationary policy driven over time that benefits hard assets? I've never seen a setup like this in my lifetime. At the same time as we're seeing all those issues with the collateral of a fixed income that is likely to drive, prices of some financial assets that are historically expensive a lot lower. So very interesting dynamic going on in markets. Sorry to go long here, but that's my
no. But and by the way, there's nothing you've said that I disagree with, right?
So good.
All that I would argue, and I myself, but am on the well, no, but I don't know if it's good or not. But what I would say is that it's so a few things. One is I myself believe in the commodity cycle from a longer term perspective. I'm with you on the commodity to equity ratios and underinvestment. There's no disagreements on that. And yes, there are going to be these waves, right, of inflation. It's ultimately about the path with which it plays out. So you could certainly have a few deflation pulses, which would be a credit event, right?
Yeah.
And then another wave higher in inflation. So that's one thing. So the other part of this is, you said it correctly, right? It's like, how can something not break when you're using interest rates on discounted cash flows? There's another dynamic which hits the real economy, which I think is not really stressed enough in the traditional media, which is that if you're a business owner, okay, and you've got to figure out what projects you want to take on next year, right? You do what's called a net present value calculation, NPV. How do you even know what discount rate to use when the volatility of the discount rate is this high, right? It basically freezes activity because there's no certainty, or at least illusion of certainty, around what to discount with, because it's moving around so much. And it could be the decision between taking on a new project, new business line, new offering, a new service, and not doing that at all, right? Because of margins of whatever is being considered. So the issue, I think, is more around the speed dynamic. The credit spread part is bizarre to me as it is to you, but typically when this stuff blows out, it happens very suddenly. It's not supposed to give people an opportunity to benefit from it in advance.
Yeah. And to your point, and then you see what's the bullish take on credit spreads? What's the bullish take on junk bonds? I think Goldman Sachs put out a kind of bizarre video of this lady speaking, very positively about junk bonds and how basically they're, if you looked at their credit situation, they look much more attractive than they did in the past and so forth. And look, junk bonds don't have a lot of history, right? I mean, they go back to the late 80s and early 90s is how much history you can get in terms of the data on that. We haven't really seen, this more inflationary regime, playing out with the corporate bond side. I think it's going to be very destructive. I think that is the elephant in the room that a lot of people are missing. And it's important to point out that the Fed had to step in to buy LTD ETFs not too long ago. And I remember somebody, I think was Ronnie Stefrole from Incrementum AG, put out a tweet and asked, what is the most contrarian opinion out there? And this was maybe somebody can look that up on Twitter. That doesn't really matter, but it was probably 3-4 months after the market really bottomed in March. And so, call it whatever, September, November period. And, my answer at the time, because I really thought, and I wasn't sure, by the way, I was just saying that is a contrarian opinion. That's something, very contrarian than what most people think was, LQD was being short investment grade bonds because, and everyone just crucified me. It was like, no, if the Fed is buying that, how dare you to say that? And look at the LQD chart. It's amazing. I mean, I wish I would have stuck with my own opinion there, but, and then it makes you think, what are some other things that look like that today that are very, consensus views? I mean, Michael, I mean, imagine if you had a drink every time or take a shot of something, vodka or anything like that, every time someone recommends you to go and buy, tips because there's nothing wrong with getting 5% on a risk-free instrument. Is it really risk-free? Sometimes I think, well, is it, and maybe it is. And I think it is because I think Fed can, print as much as they want. There's never going to be any issues on that. But my point being, when something is obvious, is obviously wrong. And so I wonder what is wrong about that view itself as well. But going back to the corporate bond market, I'm very concerned. And I think it's linked to the treasury problem. I mean, knowing that 45%, almost 50% of the debt, the federal debt is going to have to be refinanced in 3 years from now. And just knowing that 15 months ago or so, we're basically at zero interest rates. I'm really thinking, how will the government structure that moving forward? Right now, 50% of the debt is T-bills, 40% is notes, 15 or 12% is actually the longer end. So, will they reduce that longer end portion and allow yields to rise? Because who cares, right? That if long treasuries start to have their yields rising, uncontrollably, nobody cares because that's not going to hit the interest payment side from a government perspective. Obviously, that will have an impact in how do you discount a business and so forth, or junk bonds and other things. But I keep thinking, I mean, that we know the government is trapped and we know there's some big issues here and we haven't even seen a recession yet. So how will they structure this? My best guess, and I would ask you as well, what's your best guess? But I think they're going to run a large, massive book of T-bills, much bigger than now. 40% of the overall debt's going to be that. They're going to have to roll that every year because that's the only way they can have control over yields and somewhat control. I don't think it's full control, but it's more control than what it is in the long end of the treasury curve. So I think those are all very important questions that will have impact on assets that are linked to those things. And I can't think of corporate bonds not being part of that. I can't think of mega caps. And what did I miss this last 12 months? I definitely missed this rally on mega caps. I mean, I would never thought that would be, there's major divergence between that and other markets. I mean, Nasdaq's still up 30%. To me, that's an opportunity on the short side. A lot of people disagree, but yeah, so that's, to me, that's some of the views in markets currently.
Yeah. And again, I find myself nodding as you're talking through that. I mean, I tend to be very anti-shorting just because, directionally, it's hard to make money. You have to get it perfect, right? But what I would say is it's not a bad idea conceptually to do a simple spread trade of the NASDAQ relative to everything else, because either the NASDAQ catches down to the weak breadth or the weak breadth catches up to the strong NASDAQ, right? And if that spread is sort of what you're playing more than the absolute direction, I think. But it is interesting. It's funny, like in the media now, they're hammering this idea that you need to have a crash in stocks for treasuries to get saved, something that I floated out there a week and a half ago. And actually, I'm sharing at the top of the nest data that proves this out. It is actually true. Even when you go back and include the 70s, you go back to 1961, as far back as the data allows you. In the top 1% of stock market declines, those real kind of aggressive drops in beta, treasuries rally. So where I'm going with this, Tavi, is I don't think you necessarily have to have this dynamic, but is it fair to say that in order to stop the capitulation in TLT and long duration treasuries, you need to have some real immediate tail event panic in equities?
Well, I can perhaps agree with that. I think, boy, I put on scales, right? I mean, not too long ago in our live presentations that we do every Friday, actually, I said I was 0 to 10, I was a 9 of how bearish I was on treasuries. I did not know it was going to happen this quickly. And I had a view about the debt ceiling because I knew how treasury issuances happen after debt ceilings. And I was very concerned about the level of those issuances with the estimates that were out that they were posing was like $1 or $2 trillion by year end. And we're already surpassed that in just a couple months after that. So, the federal debt growing at 20%, annualized rate right now. It was growing 18% just 2 weeks ago. And then now with those increases that we've seen, it's now growing to 20%. It is absurd. It's completely unsustainable. It's, again, the elephant in the room one more time. Keep saying that, but it is. And I think the Fed has a real problem here in terms of the falling, but I think they also want the 10-year yields, the long end, to be above Fed funds rate. I do think that might be a desire from the Federal Reserve side. Does the Fed want to crash the economy to create demand for treasuries? Potentially. I think that's not a thesis that is, essentially, I think people are talking about the crash in equities, but not so much of the role of the Fed. The role of the Fed is to reduce, to make sure there's financial stability, that especially on the treasury market, which I think is absolutely critical. But from a macro analyst side, you look at the spreads in the 2 versus 10s right now. There's been steepening, very sharply. And that, when you see a deeply inverted curve, and then you have, how many times have we seen this in the past? Deeply a yield curve inverted with, a very steepening dynamic months after that. And what does that do usually? That usually is linked to a hard landing. And so it's hard to be very bullish here. It is. I just don't. I just think that valuations are just in the land, and they've been there for a long time. I just don't understand why anybody would be buying a business trading at 100 times earnings when you can buy a Brazilian bank, very established business for 30 years, trading for 4 times earnings, 5 times earnings. That I don't think it's going to go out of business, that I think can actually do very well in a commodity environment. So I am, I think there's some really interesting divergences in foreign markets versus US. And I think the probability of a hard landing in the US is being increased drastically. I would suspect that credit spreads are at very high risk of blowing out because of all this. And, I think the real dollar is wrong. I think we're still going to see rates, if not increasing because of this stubborn inflationary problem that we're seeing still, that is still a very big problem for the Fed.
To reset the remaining 20, 25 minutes here, everybody please make sure you follow Tavi here on X. If you want to come up and ask questions, click that bottom left mic request button. And as always, this will be an edited podcast under Lee Lag Live on Apple, YouTube, and Spotify. All right, so let's expand on the emerging market thesis. Now, I will preface this by saying this has been one of the most fluctuating parts of the investable landscape, and you know that as well, right? The emerging market side has been wildly disconnected from U.S. markets. A lot of that you can argue is because of the unfair advantage of QE, which resulted in the FANG phenomenon, resulted in large cap growth, mega cap dominance, while everything else around the world really just languished. I say that's been wildly frustrating from experience because the problem the last decade is that the risk on is a relative momentum trigger of either large caps, small caps, and emerging markets. It rarely goes into large caps, which means it usually goes into either emerging markets or small cap because they're more volatile, triggering the momentum side of things. And anybody that's tried to do any kind of trading strategy, momentum strategy on emerging markets has gotten their ass handed to them, right? It's been like death by 1,000 cuts trying to play emerging markets, which for a decade have gone nowhere, right? Even worse after inflation. So you've had a lost decade plus in a large part of the world, despite all the narratives still being valid around demographics, consumers, wealth, all the stuff that was the reason why emerging markets are going up prior to that, the GFC. What's needed for a real secular shift? Because who knows? For all we know, emerging markets could now be going through what Japan's been doing for 30, 40 years, just a whole bunch of sideways.
Well, I think what needs to change is we need a commodity cycle. And I hate the term emerging markets personally, just because I think it involves a block of countries. And what we have in terms of BRICS is nothing but a block. I think there's very distinct types of economies within BRICS. I don't think China, for instance, should be linked to Brazil at all. China is an authoritarian regime with a commodity importer, type of profile. You've got Russia, which is the opposite in that front. They are a commodity exporter, very resource rich economy. However, also with an authoritarian and regime with a total geopolitical messy leadership. And then you have India. India is less of a political mass, much less than China and Russia, but also a commodity importer. They're not really resource rich economies like, I'll say Brazil. Brazil is a resource rich economy that does not have a authoritarian regime, although a lot of people think Lula is being authoritarian. I remind people, go back to the early 2000s, and I'm not a Lula supporter at all. I'm actually the opposite, but if you're asking my political views, but that doesn't matter in markets here. What matters is that there is, I think, a underlying thesis in that should favor hard assets, that should favor natural resources, given this chronic period of underinvestments in that space. And as institutions look for ways to deploy capital in the space, I think that's such a small, thin market that eventually it brings you back to look for alternatives like economies that tend to be, do very well in periods of more favorable commodity markets. And so, I think Brazil is a classic example of that. You can see that reflected in historical valuations of the country. And so if you look at valuations of Ibovespa or even better equal weighted metrics or the banks and other segments of the economy, you can find that we've had a very undervalued period right now where, and particularly relative to developed economies like the US. So if you look at what's the average valuation of a business in the US versus the average valuation of a business in Brazil, you will see that spread has never been that more, extreme. And so, to your question now, what triggers that? Well, I think commodity markets needs to be one of the triggers. I think we're seeing signs of how things have been behaving recently. Number one, who would have thought how well the Brazilian real has done, despite the fact that we've had the steepest, rate hike cycle in many decades, if not in history. And, in terms of the short term of increasing rates and so forth. And so if you think about that, I think, I would believe that a lot of macro folks would never believe that Brazil would have been as resilient as it has been. And the same thing goes for Mexican peso. And the same goes for other economies like in South America that have actually held up very well in this challenging rate cycle environment for developed economies, And so I think those are important things. More on that. Well, let's think about the value to growth transition or the growth to value transition, which has mostly to do with the cost of capital being so high and they're not that they need to continue to rise, but if they just stay where they are and on top of that, you have, the need for analysts and investors to be really emphasizing the profitability of a business. And as you see people rewarding profitability, rewarding strong margins, rewarding making money, rewarding value investing approach and analysis that we haven't seen in a long time. As we see that shifting, I think Brazil can do very well because that is a value segment of the global equity market right now because things are so cheap. So, and if you've been navigating the Brazil, market for a long time, you will understand that given the fact that it is an economy that has always had a very high cost of capital, always, the market itself is built on value investing approach. Okay. There is no growth approach in Brazil. I mean, we don't see much of that. I mean, if you think about most of the analytical work being done in the country and most of investors, defending their thesis on most of their investments in the Brazilian market. And if you see cases of success in the Brazilian market, you will find the majority of them are very much value driven. which is very different in the US. US is very growth driven. And I think that's cyclical. I think we've been through a period where people have been favoring growth and so forth and top line and so metrics. And I believe that's about to change. As we see that changing, I believe that the equity market in Brazil will do very well. So, ultimately, if you're of the view that the Federal Reserve is trapped, which I am, and having that view is challenging because it doesn't tell you about timing, right? I mean, I think all of us know the Fed is trapped, but how do we capitalize on that is a much more relevant question. And I think the Brazilian market is, you want to be deploying capital, in my view, on pullbacks. I always say don't go. I don't have 100% of our book there. I mean, it's. I think we have currently between 5 to 7%. And, I can see that growing to 10, 15 in 5 to 10 years. It will never be much bigger than that. And I know never is a strong word, but will probably not be a much bigger than that. So, because of the risk, I understand the political risk and all that, but everything has a price and things are really cheap and really undervalued. One last thing, Michael, if you don't mind. Have you looked into the Big Mac index recently? And, being the person who lived in Brazil and lived in the US, there's some really interesting analysis there as well. I've never seen a time in my lifetime in the US that the cost of living has been more, so expensive to an average person who live here, but particularly relative to an emerging market like Brazil. And if you look today, a Big Mac in the US costs more than a Big Mac in Brazil. And that hasn't been the case for a very long time. And so that flip on how expensive a Big Mac is in the US versus in Brazil. I mean, a Big Mac in Brazil has always been more expensive than in the US. And if you think about the cost of living itself in Brazil, has always been more challenging to really figure. And it's not. I mean, and especially for a person who earns in dollars, and people are going to start figuring that out. When do we see this capital inflows to Brazilian markets, especially in real estate and debt and FX, given the carry? And I can go on. And if you look at the real estate prices in Brazil, we haven't seen a bull market there in a long time. We have seen a bull market in the US. And so, is that a place where people may start deploying capital into just because it's the cheap alternative? I can see that happening. And so, there's a lot of takeaways from the analytical side of what's happening and sort of this multi-asset class analysis approach in Brazilian markets. And I just happen to be very bullish just because of my views on hard assets and commodities and how the Fed ultimately has to be the buyer of those treasuries that have been falling, seeing falling demand. And that's going to be a very important issue moving forward.
So first of all, let me just say, I hate that you brought up Big Mac because I'm doing intermittent fasting and that really makes me hungry. And I'm actually now doing an extended fast. So you're really killing me on this. But hold on. So I do think this is one of the more misunderstood dynamics of the emerging market versus developed dynamic, which is exactly what you said. It's ultimately a style play. It is a value style, whereas US is growth, right? I mean, oftentimes these kind of factors have really big sort of monolithic type of implications on not just something within borders, but outside of borders. So that relates to commodities, that relates to Brazil, that relates to financials, energy, materials, which are usually kind of the value sectors. But I think in order for that to take place, and this is the real question mark, you have to sustainably break technology because that's where the growth momentum is coming from, right? And it's just money's chasing that growth narrative, which is momentum in, now the AI play, which suddenly everyone's quiet on. Not a surprise because it was a mini mania to begin with. But I guess just flipping the question on its head is, what would it take to break the love for technology? Because I think, technology's pain should be values gain, which means, good for emerging markets broadly.
Well, if I had that answer, Michael, it'd be, ultra billionaire right now, just because I've been trying to short tech stocks and it's just amazing. And by the way, part of that trade has been right. What's been wrong is the mega cap section, as you know very well. If you look back in the software companies and so forth, they've all pulled back massively. I mean, software companies, we used to be short them back in 2020, 2021, and, their valuations never came back. which to me, it's kind of interesting because we run a quant model here at Crescat, and it's very unbiased and looks at over 50 different value metrics, and they all kind of mix with each other to kind of create this final score. And it's really interesting that software companies are starting to score very well there. I mean, that was to me interesting as well from a commodity perspective when I see kind of most commodity led industries were starting to score really well in this unbiased model. It's a confirmation of that, of a view, I guess, is how I see it. And so I find it interesting that there is maybe, if somebody wants to play the spread between, a software company versus a mega cap, kind of interesting. It's not my play. I'm not doing that. I'm just saying that's, potentially in one way to be hedging the risk. But what it takes, boy, I think it's the understanding of the market that AI is actually much more capital intensive than potentially, because that's the main reason. I mean, if you think about the divergence between treasuries and NASDAQ 100, for instance, it really started after ChatGPT was released. And you can see those charts, and it's really interesting how, and the main reason for that, I think, has to do as well with the fact that most of those markets have had the opportunity to have the first, it makes sense in that sense of it makes sense in that front, just the fact that they had the first access to those machines and so forth to really develop their businesses and so forth. Now, how expensive that is to moving forward to create a profitable business out of AI, I think it's going to be a lot more challenging than people think. I think there's going to be a lot of disruptions in mega caps themselves. I would think as well that AI, if anything, is an enabler of smaller businesses. Now, when I think about AI and what I use to my own business and to my own life professionally, is that it enables me personally to almost have a 1,000 analyst team helping me to, do things better in general, right? To do analysis better, to do my work, my job a lot better without having to hire anybody. So enables me as an individual and thinking about as a small business to become bigger without actually having to hire a bunch of people. Well, that's interesting. And, think about from a perspective of even, going back to the emerging market idea, will that lead to better businesses in emerging markets relative to the US? And right now, the way the market is seeing this is that mega caps should be by far the biggest benefiters of all this, when I actually think that the gap between a large and a small business has been closing, given the fact that AI is such an enabler of different, labor capabilities that we didn't have in the past. Think about internet, right? I mean, internet allowed you to start a business without having a physical location. In the 90s and early 2000s, it was something unthinkable before, right? I mean, if you want to start a business, you better rent a place and think about what that business plan is going to look like and so forth, and then start a business. Much more costly and difficult. Now you can just start a website and, from your bedroom or working overnight. And guess what? Now you have a business on the internet. Well, that was the early two. Now on top of that, you can leverage that up. Now you have a team of 100, 1,000, an infinite amount of analysts there to help you, to accomplish more and more of your duties to get to your successful level. And so, I think that's an interesting perspective of how AI could potentially help smaller cap businesses to do better than mega cap ones. And I keep thinking about emerging markets because emerging markets, there has been a reason why we've had a premium on developed economies versus emerging markets. And one of the main reasons for that is the quality of labor that a lot of people dismiss. And quality of labor in the US is premium, right? And you can call, it has to do with the immigration. I'm not even going to go there. I'm just going to say it is premium relative to Brazil. It is premium relative to even, to China, to India, to Europe even. And the fact that it's premium is also the reason why businesses are so very efficient compared to other parts of the world. And therefore, a huge part of this premium as well in terms of valuations. And how do we see AI playing a role here is I think is closing that gap of that differential of labor quality in those places. So that's to me another thing, another theme, kind of an approach towards understanding AI potentially that could be very, very intriguing here for the following years in markets too.
Yeah, I guess it's just a question of what would it take to break the relative strength? Because it's like for gold and for commodities and for value, and emerging markets have momentum. They have to have momentum, right? I mean, that's the dilemma with this stuff, right? So in order for there to be rotational momentum, there's got to be something that breaks the old momentum, the old leader. And every time it
Right.
looks like that's about to happen, right? It just doesn't want to
Mhm.
stick. I mean, it's interesting because if you look at the growth versus value relative ratios, value was working, and then the regional bank crisis hit in what, March, right? And then everything just stopped, and it went right back into tech. Then we went back to the old playbook again. Oddly enough, maybe you need to have another crisis, but just not in the bank side, right? To really force that, but it is just an interesting dynamic quantitatively.
Well, mostly, I mean, my apologies. I didn't really answer your question, so I'll try to get there. So I went around to talk about AI, but not really answer that question specifically. I actually think, those are ultra long duration assets, mega caps, I think. And certainly it reflects euphoria on AI. I don't think this euphoria is sustainable personally. I think what breaks this is this idea of, let's just think about the euro dollar curve, for instance, as we see the euro dollar curve not pricing in cuts and so forth. That is one part of the market that has to be, highly impacted by. The second thing is inflation. I think inflation decelerating has, had an incredible impact in helping those and fueling this demand for mega cap stocks and so forth. I think that potentially, if we see inflation bottoming at least at those levels that they are currently, it could be very problematic for AI. So I think that's probably the most important aspect potentially, and it's also a dynamic of earnings too. That we often forget, but earnings for mega caps. I mean, if you think about mega caps, most of them run almost monopoly businesses in different fronts. They don't fight each other as much, and they have very much as close to monopolies as it gets in terms of their own segments of their own parts of their industries. And I think that we're starting to see those companies can only grow so much. I think they've grown in terms of market share as much as they can grow, in my view. And so you're starting to see the only way to improve fundamentals is to actually start raising prices, which is also, in my opinion, inflationary. You're seeing that with the streaming businesses, which is interesting, and other parts, even Apple and some others. Now, I do think that it is a function of inflation, a function of interest rates to break this leadership. And if inflation is about to start bottoming, I would suspect that there's going to be some significant catch up to the downside on mega caps relative to the S&P equal weighted and other indices. And so, I would be very concerned about that. There's, a double top formation in the equity in FANGs stocks right now. If you look at the FANG index, you can see there's a double top formation. You can see the same with semiconductor companies too, which I think it's been what's been also driving this market, especially Nvidia, as everybody knows. There are other parts of that too. And so I think that just as this rate environment is going to start breaking this leadership, and along with inflation bottoming, is probably the most important factors. Do you agree with that? I mean, that's to me that those are the most important ones, and I would say that's also the earnings side of it, as we see AI becoming more and more expensive, and we start seeing that translating into lower earnings and so forth, given the necessary investments to continue to fuel this euphoria towards those developments. And as we start seeing, those really high expectations not being met over the next months, it's going to be challenging to remain, in this bullish trend, particularly relative to the overall market.
So real quick, I have two theories around how you could break the tech momentum, which could restart the value secular relative strength. One is what you just hit on, but is the least likely to happen in the near term, which is much better enforcement on anti-monopoly types, right? Which is there's all kinds of nuances in that, but I do think that it's true, right? That these kind of quasi monopolies, that a lot of these tech names have, you can argue it's justified because of network effects in some instances, but that would be one way to break it. But I always try to go back to the simplest answer is probably the right one. Simplest answer is, why is it that large cap, market cap weighted averages have done so well for the last decade? Because suddenly all these 401k options have a default option where a portion of one's income goes into basically Vanguard type funds, which are market cap weighted. So you create this kind of structural bid that favors market cap weighting as a strategy. As people are employed and they get that automatic flow, automatic bid happens in their 401ks. What's the simplest answer there? Yeah, because that's resulted in a lot of the concentration around tech and market cap weighted averages. If unemployment does rise in a meaningful way, people get laid off. We would know that people have tremendous credit card debt on a rolling basis. You hear these stories occasionally of people that dip into their 401ks, into the IRAs, they take the penalty because they have to pay for day-to-day expenses. That causes them to sell off some of these market cap averages, and maybe at the margin, that's what actually breaks that concentration. Could be far-fetched, right? But I do think that a large part of that distortion is literally just because of automated flows, which means, at least from my vantage point, the S&P, the NASDAQ is no longer a leading indicator. It's going to be more coincident to unemployment rising as opposed to everything else, which I think is more of a leading indicator. I don't know if that makes sense, but that's been something I've been thinking myself for a while.
No, I think that's really, I think you hit the nail on the head in terms of the passive flows and so forth. And I would agree. I think that's an interesting way of thinking of how things can break is through that process of capital flows. And I would just say one thing that I really think this wage pressure is, if we think about the real growth in corporate earnings throughout history by decades, 2010s was by far the highest, the most strongest, the most robust corporate earnings growth in real terms that we've seen in history. And there are other 2 decades that we've seen this in the past. And this was in roaring 20s, okay, and the 90s with the technology and all that, those developments happening. And so if you think about those periods, the first thing that came to my mind was the subsequent decade after such a strong period of strong earnings, meaning unsustainable. What happens usually is that the subsequent decade tends to be very challenging. Well, the subsequent decade of the roaring 20s was the Great Depression. And I really had 2 major recessions, the Great Depression itself, which was a depression, not a recession, and then the 1937 that a lot of people don't look at, but that was a brutal recession as well, period. Then after the 90s, we had the tech bust, which was a significant downturn in contraction in economy, followed by the '08 as well, which was also a difficult period. What is the next one here? I don't know. I don't think we've ever seen a period when valuations are so high. Look, CAPE ratios, a great example, at 30s, and inflation is higher than historical standards. Forget about, the waves right now. Just think about just being higher than historical standards, causing costs of capital to be higher, causing interest rates to be higher than average, at least at least relative to the prior decade, where has really helped to keep those robust earnings that we saw was the fact that cost of capital was so cheap. Although if you look at interest rates right now, they're back to historical average. And so to me, it's going to be very difficult to keep up with this next decade, which is started in 2020. And we're 3 years into it, which, by the way, we've already seen more growth in earnings than we saw in the relative terms to those 3 other very robust periods of corporate growth in earnings, which was the prior one, the 90s and early 20s. And so I think that's, when I think about what causes that compression of multiples and squeeze of margins, I can't think of anything that wouldn't be more meaningful outside of deglobalization and all those other things that causes logistics but also this inequality issue, which to me is going to be, such an important thing and causing this wage pressure where earnings, they can be squeezed. I mean, there's enough juice there to be squeezed to, reduce the profitability of corporations in general to actually pay more for labor. And this is not a political view at all. I'm just saying, there is room for a squeeze of margins, and companies are still being profitable, by the way, but a significant squeeze of margins to accommodate this societal pressure of wages and salaries supposedly being higher because of the elevated cost of living. And as we see that, I think mega caps are not going to be, not going to be immune to those changes. I think they're going to also be, very much involved in that. And I can't think of a period where we're not going to see, further issues in those earnings. And so I very much disagree. I think with the take in the markets right now where, people, the only way to justify the multiples currently would have been if we do see, a continuation of these robust earnings from the 2010s. And I very much disagree with that view. I don't think we're going to see that at all. I think this is going to be very challenging personally.
Tavi, for those who want to track you, follow more of your work, where would you point them to?
My Twitter at Tavi Costa. I don't recommend that. Kidding. You're welcome to follow my research. There's also at crackit.net. You can find more about our funds, but also research pieces that you want to, be bored with macro analysis. There's some log ones, 30 plus pages of research almost every month that we put out that we share with the world. And there's a lot of thematic ways of thinking about, global macro overall.
Everett, again, please make sure you follow Tavi Costa. This was a great conversation. Like I said, I find myself nodding to a lot of what Tavi says, and I think he's criminally underrated in terms of just getting more and more media exposure. I say that sincerely, Tavi. So I appreciate you joining. Thank you, Tavi.
Thank you, Michael. I always appreciate talking to you, man. Thank you.